Welcome to the Risk Wheelhouse, the podcast where we navigate the ever-changing seas of risk management and technology. Join your hosts, Ori Wellington and Sam Jones, as they steer you through the latest trends, insights, and strategies shaping the future of integrated risk management. Ready to chart a course towards success? Hop aboard and let's set sail into today's deep dive.
Welcome to the Deep Dive. Today we're digging into a really interesting, very current piece from McKinsey & Company. It just came out this month, May 2025. It's called Governance, Risk, and Compliance, a new lens on best practices.
Yeah, and our plan today isn't just to, give you a summary. We really want to unpack McKinsey's view on where GRC stands right now, and maybe more importantly, read between the lines a bit. What are their findings suggesting about the future? How should organizations, maybe like yours, be thinking about risk management to really get ahead?
Exactly. So we've got the McKinsey article, and we also have a pretty sharp analysis from Wheelhouse Advisors to help frame it. And the mission really is to pull out those critical insights. And the starting point, which both sources seem to agree on, is that even with huge investments in GRC, a lot of companies just aren't getting the results they expect or need.
That's really the crux of it. McKinsey did this survey, nearly 200 corporate leaders, and what they found was, widespread underperformance across governance, risk, and compliance. They've zoned in on 5 specific areas they think need, frankly, significant reform.
Okay, so almost 200 leaders surveyed, problems across the board. Let's get into those 5 areas. What are these fundamental weaknesses that McKinsey is seeing?
Well, the sort of underlying message here, and this is where it gets quite provocative, I think, is that the traditional model, the way we've historically done GRC, it might just not be fit for purpose anymore. Not with how fast things change, how complex the business environment is today. McKinsey doesn't explicitly say GRC is dead, but the analysis points very strongly towards needing a major shift in thinking.
Interesting. So these 5 areas McKinsey highlights, they're basically the symptoms of why the old GRC model is struggling.
Yeah.
The limitations of how companies are doing it now.
Precisely, yeah. The first big one they point to is a lack of strategic integration. Just think about how it often works on the ground. Risk might report up through the CFO's office. Compliance maybe sits under the general counsel. And the board kind of interacts with these areas separately, maybe episodically.
Right. So you've got these different functions all dealing with related stuff, but kind of in their own little worlds. No unified strategic view.
Exactly that. And the big consequence, McKinsey stresses this, is that risk just isn't at the table often enough during those really crucial high-level strategy discussions. It gets treated like a separate checkbox exercise, not something fundamental to how the business plans its path forward. You might see a company make a huge strategic bet and only really dig into the potential risks afterwards.
That definitely paints a clear picture of a disconnect. Okay, what's the second systemic weakness they flagged?
Technology underutilization. Yeah. And this one might feel a bit strange, right? Because companies have spent so much on GRC platforms.
Right, huge investments there.
But McKinsey's data, it shows that, surprisingly, 42% of companies feel their GRC systems actually need improvement.
Wow, 42%. So all that investment and nearly half feel the tech isn't quite cutting it.
Well, the analysis from Wheelhouse calls this the illusion of integration. These platforms, they promise this connected, holistic view, but in practice, they often end up being more like very sophisticated digital filing cabinets.
Okay.
They're great for documenting things that have already happened, ticking boxes, but they don't always give you that foresight, that agility you need to actually respond proactively to risks as they're emerging. It's a bit like having a fancy alarm system that only goes off after the break-in.
I get it. So lots of data maybe gets collected, but it's not necessarily translating into smarter, forward-looking decisions or spotting problems before they happen. What's area number 3?
This one's about leadership, the undervaluing of risk leadership. And here's a stat that really jumped out. McKinsey found 44% of heads of risk are positioned more than one level below the CEO.
44%. More than one level down. That says a lot about where risk sits in the pecking order, doesn't it?
It absolutely does. When your top risk person is, multiple layers away from the CEO, from the ultimate decision maker, it almost automatically frames risk as more of an operational thing, a detail, rather than a core strategic element that should be shaping the company's direction.
Right.
It suggests that, maybe the insights from the risk team aren't getting the airtime or the weight they need at the very top.
Okay, lack of strategic connection, tech falling short, risk leadership too far down the chain. What are the last 2 weaknesses McKinsey points out?
The fourth one is weak alignment with incentives. And this is quite telling, I think. 68% of organizations, according to McKinsey, do not link executive compensation to things like compliance culture or ethical performance.
68%. That seems like a massive disconnect. I mean, you hear so much about tone at the top and the importance of ethics.
Exactly. But if it doesn't actually hit the bottom line for the leaders themselves, how much bite does that message really have? Organizations talk a good game about tone at the top, the idea that ethical leadership sets the standard. But if the structure, the incentives, don't back that up, if there's no direct consequence for ethical slips or weak compliance culture and how leaders are actually paid, well, it suggests maybe financial results are still the primary driver, perhaps above all else.
That's a powerful point. And the fifth and final weakness.
It's the failure to advance from tactical to strategic. What McKinsey saw was a real lack of forward-looking capabilities built into most GRC models. Things like robust scenario planning, really thinking through the what-ifs, or stress testing, how resilient is the organization really, and horizon scanning, actively looking out for those emerging over-the-horizon risks. These things are often missing.
So instead of proactively looking ahead, mapping out possibilities, preparing, the focus tends to be more on looking backward, periodic reviews, ticking off items on a static risk register.
Precisely. It fosters a reactive stance, right when the environment demands proactivity, demands agility, and the ability to adapt to new threats and uncertainties really quickly.
Okay, so those are the 5 big weaknesses McKinsey identified. Now, the wheelhouse analysis connects this really interestingly, suggesting that all these findings are maybe implicitly pointing towards something like integrated risk management, or IRM. For anyone listening who maybe isn't deep in this terminology, could you just briefly explain what IRM is about and how it links to these weaknesses we've just discussed?
Yeah, absolutely. So integrated risk management, IRM, really at its core, it's about breaking down those silos we talked about earlier. It's a philosophy, a set of practices aimed at embedding risk thinking into all parts of how an organization makes decisions, how it sets strategy, how it operates day to day. It's about viewing risk not as this separate police function, but as just an inherent part of doing business.
Okay.
And what's really striking is how neatly McKinsey's 5 big recommendations, their imperatives for reform, line up almost perfectly with the core principles of IRM.
So it's almost like McKinsey diagnosed the problems, the symptoms, and IRM represents a kind of comprehensive solution, even if McKinsey themselves didn't explicitly label it that way.
That's a great way to put it, yeah. Let's just walk through it quickly. Take McKinsey's first point, about tone from the top. Wheelhouse points out that IRM addresses this head-on. How? By making risk accountability a non-negotiable part of strategic dialogue at every level. It means clear C-suite ownership for different risk domains and regular holistic reporting to the board covering all kinds of risk, not just, reporting on financial risk separately from compliance risk.
Makes sense. So truly embedding it at the top. What about the strategic lens point from McKinsey?
Well, IRM frameworks are all about creating that enterprise-wide view of risk appetite. But crucially, these aren't just dusty policy documents. In an IRM world, your risk appetite is actively, dynamically linked to your KPIs, your key performance indicators. And it directly informs things like scenario planning, capital allocation, business resilience strategies. It makes risk appetite a living part of strategic decision-making.
Okay, and how does IRM approach McKinsey's call to fix fundamentals?
So traditional GRC often looks at controls in isolation, right? Or analyzes incidents after the fact. IRM tries to connect the dots. It links your policies, your identified risks, the controls you put in place, any incidents that happen, and your actual performance data all together.
Oh, okay.
This allows for much richer, more predictive insights. You start moving beyond just reacting to yesterday's problems and begin to see patterns, anticipate potential future issues based on that connected data.
Very interesting. Using that connected data to get ahead of problems, not just clean them up. What about the tech piece? McKinsey's Embrace Tech plus AI.
This is really where modern IRM shines. It's built for this. IRM platforms today are increasingly leveraging AI and machine learning for things that were, frankly, science fiction in older GRC systems. Think about continuous controls monitoring AI, automatically testing if your controls are working 24/7, real-time risk monitoring across huge data sets, even much smarter data-driven third-party risk assessments. These are the kinds of capabilities that IRM enables.
And the last one, McKinsey's point about revised incentives.
Yeah.
How does IRM speak to that?
Because IRM promotes this holistic view, this idea that risk management is everyone's job, it naturally flows into rethinking incentives. It supports tying executive performance metrics not just to hitting financial targets, but also to operating within agreed-upon risk boundaries, especially for big decisions like major capital projects or large-scale transformations.
Right.
It helps build a system where managing risk well is seen as integral to and rewarded as part of successful leadership.
When you lay it out like that, comparing them side by side, it really does feel like McKinsey's critique of current GRC practices implicitly makes a very strong case for shifting towards something much more integrated, like IRM.
Exactly. And the wheelhouse analysis really drives this home. It argues that McKinsey's findings aren't just suggestions for minor improvements. They represent a pretty fundamental critique of the traditional GRC paradigm itself. It's basically saying that GRC, as often practiced, hasn't successfully made the leap to becoming the truly strategic, value-adding function that businesses today desperately need it to be, especially with regulations constantly changing and business getting ever more complex.
And that key missing ingredient, the thing that keeps coming up in McKinsey's findings and the IRM response, seems to be integration. Integration across so many different dimensions.
Absolutely, you nailed it. It's integration between, say, board-level governance and actual operational execution, not just oversight from afar. It's integration between the grand business strategy and the organization's real appetite for risk, moving way beyond static lists. It's the integration of powerful technology with human expertise and judgment, rather than relying on clunky manual processes. And maybe, just maybe, the most important integration of all, weaving risk awareness deep into the company culture by aligning incentives and making accountability clear.
So the message isn't just buy a new GRC tool or add another compliance layer. It sounds much more fundamental than that. It's about potentially rethinking how the whole organization approaches risk from top to bottom.
That's precisely it. These aren't surface-level tweaks McKinsey's hinting at. They point towards fundamental shifts in the operating model. And as the analysis highlights, IRM is a framework specifically designed to support and enable exactly those kinds of deep systemic changes.
So wrapping this up then, the big takeaway for you listening is that this recent analysis from McKinsey strongly suggests that those traditional GRC approaches, the ones many organizations are still using, well, they might be hitting their limits. They may not be enough for today's world.
That's right. It looks like the future, if you want truly effective risk management, probably involves embracing these more integrated strategies, strategies like IRM, that are better at connecting the dots between risk oversight and actually executing the business strategy, and better at using real-time data to get insights you can actually act on.
So maybe the question to leave you with is this. Take a hard look at your own organization. Is your current approach to governance, risk, and compliance genuinely integrated? Is it having a real strategic impact? Or do these points from McKinsey, this whole discussion, suggest maybe an evolution is needed? What would that true integration actually look like in your specific context? And perhaps what's one step you could take towards getting there? That feels like a really crucial question for leaders to be asking right now.
That wraps up another episode of the Risk Wheelhouse. Thank you for spending time with us at Wheelhouse Advisors today. We hope you found the conversation insightful and actionable for your organization's risk strategies. Don't forget to subscribe on your favorite podcast platform, whether it's Apple Podcasts, Spotify, or Amazon Music. If you're looking for more in-depth analysis and thought leadership on risk technology, be sure to visit the Risk Tech Journal at therisktechjournal.com. It's your go-to source for comprehensive articles, expert interviews, and the latest trends shaping the industry. Subscribe today to stay informed. For any inquiries or feedback, please contact us directly at info@wheelhouseadvisors.com, or feel free to connect with us on LinkedIn and x.com and share your thoughts or suggestions for future topics. Visit wheelhouseadvisors.com for more information and resources. Thanks again for joining us. Until next time, navigate wisely.